Welcome to our High Rock monthly video for April. Today, we shall address how financial markets performed last month and what those implications are for your portfolios in the near term, any key adjustments to our models and special mandates, and how our managing risk first philosophy will be the key to maintaining growth in uncertain times. I am Scott Tomlinson, and with me on the call today is Paul Tepsich, who founded High Rock in 2010. We started our private client and wealth management division in 2015, and we are celebrating our 10-year anniversary of that. If you are interested in learning more about us, visit our website at www.highrockcapital.ca. Well, Paul, April was a pretty volatile month. Equity market prices fell almost 12% to start the month, but finished ultimately flat to ever so slightly positive on the month. Balanced portfolios experienced negative growth, mostly as a result of the weakness of the US dollar, strength of the Canadian dollar. I know you're going to talk about gold and silver a little later, so I'll leave that. Otherwise, anything to add on this?
Yeah, I would just add, as you can see in the far left part of the chart, and pretty much every asset class that we have up there, including even gold and silver, it was so volatile. I think it was April 7th, Scott, that the S&P 500 was from the top to the bottom in that single day was a 10% move. So I think as I recall, I think it was down 5%. Up 5% on the day. It was unbelievable volatility. So we probably don't even need to tell everybody why. So who knows? It was probably some tweet or truth social media post, but extreme volatility. And I think one of the reasons why the market did sort of bounce back and through the rest of the month was China basically saying, I think they put in 125% tariffs and said they wouldn't do any more and do a tit for tat. And then even last night, we saw what China did, wanting to sit down and negotiate with the US and also cutting their overnight rate to stimulate their economy.
All right. And as I mentioned, the Canadian dollar strengthened significantly on the back of a weaker US dollar as a result of all those tariffs. And certainly that impacts our balanced portfolios because we do own assets in US dollar terms. Usually that's functionally a good offset for when US asset prices fall. But in this case, with the falling US dollar at the same time, it was, and generally for balanced portfolios, it was not a good working hedge.
And actually, one thing I would add too, Scott, is the Canadian dollar is actually lagging versus other currencies in the world vis-a-vis the US dollar, number one. And number two, on the Carney election, Fitch, which is a credit rating agency, did put Canada under review for watch, which effectively, and they gave a statement as to why, but effectively due to our fiscal situation in Canada alone. So that is something we're going to need to watch for, is to see if our federal credit rating gets any sort of downgrade. That may be a little further off, but it's something to watch.
Yeah, good point. All right, as I mentioned, balanced portfolios have suffered a little bit. Year to date, according to Morningstar's averages, down just a little over 1%. But the 1 year still pretty robust at 9%. And the longer term averages are still pretty reasonable, 3 and 5 years. One of the things, of course, that we follow closely is the 5-year standard deviation from the mean. So how much might a portfolio swing at any given time? So as you mentioned, in one day, the S&P 500 down 10%. That's about just a little over half of a standard deviation for that particular index. So that's a lot of volatility. We pride ourselves at High Rock in trying to be better than the average as far as that the risk we take, and certainly our 5-year return relative to risk is above the Morningstar average. And if clients want to have conversations around that at any point, everybody's portfolio is different, but because our philosophy and our methodology tends to work to try to find the best risk-adjusted returns that we can. Risk is a very important part of the conversation. So anytime anybody wants to have a conversation about the risk in your portfolio, please feel free to contact us. Paul, anything you want to mention about our special mandates? If you're there, you're on mute.
I am on mute. No, I'm not. Our high yield mandate, first of all, that held in very well. Even some of the energy bonds we own, they traded off, during the month of April, 1 to 2% for the most part, and then gravitated back over the last number of days as we're into May 7th today. But energy, oil, and we can talk about that as well in the tactical model, but basically the start of April, WTI oil was around $71, and today it's trading at 58.5. So it's been absolutely hammered, both on, I think, Trump's drill baby drill, as well as, more importantly, that was a big drop the day OPEC came out and said they would likely increase production, which of course they did last weekend. So even though those things have hurt the energy market in general, they held in well, and the high yield performance held in well. Preferred shares were not quite as lucky, and as we saw in one of the earlier charts, they did get hit a little bit. Interestingly, though, the underlying investment grade credit spreads of the preferred shares that we own, life insurance companies, pipelines like Enbridge and TRAP, they barely moved. So they were largely unchanged. So those, a lot of those preferreds got hit down. Some of them are still retail traded, and I think guys really don't understand how to value those. So we did actually do some buying in the preferred share mandate. We bought a couple new line, or added to one line and bought one new line, but actually two new lines, come to think of it, in the Lifeco space. So, but we're still sitting on a fair bit of cash. So we were lucky to be long about 30% cash going into this tariff war, if you will. That's it, Scott.
Yeah, and noticeably the benchmark, your mandate outperformed the benchmark over the course of the month, and that certainly was because of the cash weighting, right?
Yeah, in preferred shares?
Yes.
Yeah, absolutely. We definitely did better than this, the so-called benchmarks and ETFs and whatnot, for sure. And high yield, we've people can contact us directly, but that's been a spectacular performing asset class for us. And as you help people on a low correlation basis to certainly the equity markets with equity-like returns.
Yeah, and significantly lower volatility, which when you look at the return relative to risk is up well over 2%, which is significantly higher than your that average balance number, or even our balance mandates for that matter. So a very, very strong performance, especially in such volatile times for the high yield mandate. Well done.
And here's me knocking on wood.
No need. Anyway, as everybody knows, our focus is always on long-term planning and making sure that we get to your goals. So again, it's always important to have conversations around your goals. If anything changes, if you're feeling somewhat concerned about the current environment and want to have a discussion around your strategy, please don't hesitate to pick up the phone. We're here to always be there to try and make sure that you're comfortable and sleeping at night. Talk briefly about global equity. As many will recall, back in the end of the year, we were rebalancing to higher cash positions for many clients. Again, depending on your strategy, but that rebalancing gave us a higher cash weighting, and this recent downturn, which brought fear to its lowest level, I think, ever, which was like 1 or 2, allowed us to do a little bit of buying for many clients who had cash. We didn't put it all to work. We put some to work. It's hard to drive to catch a falling knife, as it were, but we did put some money to work, and that's turned out to be okay. Now we're back up into almost greed territory in the fear and greed index, and another index that we look at, another set of metrics, is how prices are relative to future earnings. And then, of course, future earnings are a bit of a right now a very unclear crystal ball. But as prices came down to levels that we thought were relatively cheap, it made sense to be putting money to work, and so we've been doing that as well through the course of the early part of April. Paul, do you want to talk about the tactical model?
Yeah, tactical. I guess the first highlight is going back one of the first slides it showed, Scott, is gold and silver, which we own both of through the CEF fund, which is roughly 2/3 gold, 1/3 silver, and then we own a little bit more silver in PSLV. They've obviously done well. There's a lot of speculation and rumors as to why gold is doing what it's doing and has been hitting new highs, and we're up almost at 3,400 per ounce of bullion, and we were just over that last night. Just off slightly today, May 7th, as we speak. There's rumors of central banks that are buying gold, repatriating gold out of Fort Knox back to their home country vaults. There's a lot of rumors as to what is going on. And with the US dollar falling, remember, as the US dollar falls and gets cheaper, all these assets that are priced in US dollars should go up in price because you can buy more of them. It costs less to go out and buy US dollars. In the case, most commodities, well, I shouldn't say most. There are some like gold, silver, copper. Copper a month ago hit a new high as well. Oil is a bit different, being controlled by OPEC. So that was kind of a highlight in the tactical model. I mentioned energy before as it affected some of our bonds. We do have a couple energy equity exposures in the tactical model, being Baytex and Source Energy. They've been hit very hard, without doubt, over the past couple of months. And again, just over the past week in early May, Source Energy is right back up. I mean, the stock got down to just under $7. Now it's back up to 11. But from a high of 18, our cost base, and not that it matters because we shouldn't trade from cost. The market doesn't really care where we bought a stock or a bond. But our adjusted cost base is somewhere around $10. So it has had a good move up. It's very illiquid. And unfortunately, the government has been in a state of non-operation for 2 months, but the company is, I believe, trying to negotiate some sort of exemption from importing their sand at their mine in Wisconsin up to the Western Canadian Sedimentary Basin, where they have 50% of the market share for fracking sand. So God help us if they don't get that, because about half the production in the country would shut down. That would not be good. Baytex, same thing. The stock got hit down with the price of oil getting hit down. It's pretty obvious. But and one thing I would actually add, Scott, I am looking at adding a couple of in the tactical model, a Canadian oil producing bond and a Canadian gas producing equity. And part of the reason is that overall in Canada, the last 10 years that the federal government has had their boot on the throat of these producers, they have they've cut costs. They've not back in previous to 2015, 16, 17, they would just grow production at any cost. They ran higher leverage, i.e. more debt, and they just wanted to grow. That's, that was good for their stocks. And then when the boot came on their throat, they stared over the abyss, and they cut costs, they cut their dividends, and they had discipline, most importantly, on what to do with any free cash flow. So especially, again, they stared over the abyss in May 2020 when oil went negative. Today, these companies are entirely different. So all the companies in our high yield universe, these energy producers, oil and gas, run the least amount of leverage or debt per cash flow unit. And they have the highest ability to pay their coupon interest. So those are two key credit metrics that we have to follow when we model out a company. And they're in great shape. They can withstand some of this. Now, we have to watch the prices of oil and gas as to where their break-evens land, because they've just gone from, up at $70 a barrel, making a ton of free cash flow, to now down at under $60 a barrel. They're making a lot less, but they're in no way in danger of defaulting on their debt because they run so little debt. Some of them have zero net debt, in fact. That's an aside. Sherritt bonds reorganized. They haven't gone through our system yet. For our balance mandates, it's almost irrelevant. For our high yield mandates, it's a bit more relevant, but they haven't actually gone through the reorg department at Raymond James as of yet.
All right, and let's, if you have an update on fixed income.
Yeah, we didn't do anything. And again, there's a lot of volatility in what we call the rates market, being government bond yield markets. So, as an example, like the 5-year Government of Canada bond kind of went from 2.5% to 2.90, a 40 basis point move in a couple days. That's a big move. So volatility reigns supreme in the government bond markets as well. Overall, that part of the portfolio performed okay. When rates go up, prices go down. That does hurt a little bit. The high yield component, as you can see in the pie graph, as I mentioned earlier, that actually did okay as well. Preferred's not quite as well. That's it.
And the major issue with fixed income is future inflation. And I think while that's fairly up in the air with tariffs, it certainly looks like inflation will there's pressure for inflation to rise.
Yeah, it could be inflation, but also I think more importantly on the rate side is the crowding out effect and the amount of debt, both in Canada and the US, that needs to be refinanced. And that happened, that news kind of came out about 3 weeks ago when the US Treasury Secretary, Scott Bessent, was on Friday, Saturday, Sunday doing the talk show circuit, and he kind of let the cat out of the bag, kind of bragging when US 10-years were at 380, and said, well, they came down from 450, they're at 380, and every basis point is $30 billion of savings when they refinance all this maturing debt. So they've got a lot to refinance. Now, of course, those 10-year treasuries, once the Monday morning, they came right back up to 440. They're sitting at basically 430 today. So there is a fiscal situation going on both in the US for sure, but also in Canada that we need to keep an eye on and watch.
So the billions of cash inflow into the US Treasury from tariffs won't eliminate the debt?
Well, it's not going to eliminate the debt, God no. But it's
I'm being a bit facetious.
Oh yeah, well for sure the the cuts to that Doge has put through will be helpful. The tariffs coming in will be helpful. They did come out actually about a week ago. The Treasury came out and said their refinance would be a bit less because of some of those measures, the Doge cuts and the tariff increases. But they still have $9.7 trillion to refinance, and you can see. I mean, the rates market is not going to. Rates aren't going down anytime soon.
Yeah.
So I think it's less about inflation and more about this big refinance package that they've got to get done.
And does it factor in that China owns a significant portion of that debt?
China owns less than Japan. Japan's a huge holder, and that's part of the problem too. Is we were talking about gold, potentially being repatriated, and people buying it for safety. They're, as countries are negotiating on tariffs with the Trump administration, sure, that's one of their, it's in their arsenal and their quiver to say, we own X amount, and it's public information. They own X amount of treasuries. I mean, we don't need to roll them. We could move into, now actually, that's an interesting thing too, but they could move into other government bonds, other sovereign bonds. But a lot of central banks, all the central banks, need to own U.S. treasuries for collateral.
Right.
So they don't have a choice. They have to own them.
Yep. All right. Well, good discussion. And thanks for all that insight. Well, that's it. And as always, we want to thank you for taking the time out of your busy schedules to tune in. We'll be back with our next update at the beginning of June. So until then, I'm Scott Tomlinson, and on behalf of my colleagues, Paul and Diane, we want to wish you all the best until then.